mishaps or some of the excesses that we typically experience within the context or in the run-up to financial crisis. There is a quote here which I kind of like it. It says, "The realities of day-to-day market pressures make idealized relationship between senior management and research a fantasy." For many years, I worked in the research side, and it's let alone, senior management understanding some of the complicated products, in particular complex products that were later on proven to be fairly toxic. Even the risk control units sometimes really do not capture the full picture. If they did, we wouldn't have experienced these successive global financial crises. Is there an alternative model for more equitable, stable, and sustainable financial system? Well, that's why we have this conference. I think it's worth exploring ways of mitigating risks, but equally important, looking for alternative ways. Islamic finance, because it involves sharing loss, it does make the system relatively more resilient. So in some way, this is an important aspect to look at. No credit is extended to basically speculative or complex products, derivatives. So it doesn't mean that derivatives don't exist. It's just credit derivatives, the problematic ones, at least in the last global financial crisis, are not supported. In theory, Islam does also tame greed, if people live by Islamic code. And I think this is an important aspect of, again, problems that we face in the traditional system, to the extent that greed can be tamed. But as I said, that is something that all these issues can be discussed. But clearly, if you have a system that is more resilient, it does help. One may argue that one of the reasons why Turkey has been so resilient is to do with maybe participation banks. But unfortunately, that argument wouldn't be very strong. That may have contributed at the margin, but it wouldn't be a very strong one. The reason is participation banks are still a tiny part of the system, about 6%. That needs to develop. And I think there is an environment that is conducive of development of Islamic finance. First of all, there is demand. Secondly, even in the West, I think investors are now looking for alternative investments. They're looking for investments that are not correlated. Now, this is important because typically, if you really want to diversify risk, not put all of your eggs in one basket, you need to look at investments or instruments that are not highly correlated. If everything goes down together or goes up together, then you don't achieve the diversification. So that's why I think interest, even in the West, in Islamic finance products is likely to grow, let alone just simply in Muslim countries for other considerations. So clearly, there is huge scope for development. And I think development of Islamic finance, financial system, and products clearly is likely to make global financial system or regional financial systems more resilient or less vulnerable, at least to the type of the crisis that we have experienced recently. Turkey. We haven't spent a single taxpayer's money on bank bailouts. When? In the last global financial crisis. But when the world was in actually reasonably good shape, when there was no global financial crisis. If you go back to 1994, if you go back to 2001, we actually spent huge amounts of taxpayers' money on bailing out banks. The amount of money that was spent on bank bailouts in 2001 was equivalent of almost 1/4 of Turkey's GDP. Turkey did experience a temporary recession on the back of the global financial crisis, but the recovery was very swift. Let me show you a chart. This is Turkish GDP in real terms, in constant prices. If you look at it, yes, we've experienced a bit of a blip here. Here's a contraction. But the convergence continued. We continued to narrow the gap in terms of per capita GDP with developed world, represented by United States, Eurozone, or Japan. So Turkey continued to actually, there was a fast catching up episode despite the global financial crisis. Relative to late 2007 or end 2007, Turkey's GDP is about 17% higher today, while European Union overall is not back where it was at the end of 2007. So what has helped Turkey? What has helped Turkey avoid a significant banking system crisis, parallel to what has happened in the rest of the world, but also avoid a significant fallout, a permanent damage for the real economy? Well, I think the single most important factor was political stability. We also had made significant progress in achieving a degree of price stability, meaning disinflation. We also had put our house in order. We had a sound fiscal position, strong fiscal position. Also, we had relatively low household leverage and well-capitalized banking sector, well-regulated, well-supervised banking sector. We had lower public sector debt to GDP to begin with, and we had moderate corporate leverage, flexible exchange rate, and a good macroprudential framework. Now, all these factors were absolutely critical, and they were all in place in late or mid-2007. And those factors have helped Turkey weather the crisis without permanent damage. Political stability, I don't want to go into details, but clearly, Turkish Republic was established, in 1923, and since then we had 79 governments through 2002. So the average lifespan of a government was 17 months. But AK Party rule, which started in late 2002 as a single party government rule, has lasted for a very long period of time. And political stability has been absolutely critical to both reforms but also good performance. Price stability, we had double-digit, triple-digit inflation rates for many decades, in 70s, 80s, and 90s. And beginning with last decade, with AK Party rule, we were able to have a lasting reduction in inflation, brought inflation down to single digits. Again, if you go back to the beginning of the last decade, we had fiscal deficits running at about 10 or 11% of GDP. These are massive, unsustainable deficits. Well, with the exception of 2009, which was a very difficult year, Turkey has satisfied Maastricht criteria since 2005. And deficits are about 1% of GDP more recently. And that's why we were able to bring debt to GDP ratio to about 35, 36%. And the downward trend continues there. We've been satisfying Maastricht criteria since 2004. So a combination of low debt to GDP and low deficit has been critical in restoring credibility, maintaining financial market confidence. Banking sector is still well capitalized, but even during the crisis, capitalization ratios were very high. Typical regulatory capital adequacy ratio is 8%. But if you look at Turkey, even today, it's running at about 2 times, roughly about 16%, 2 times the regulatory requirement. And we do have a target capital adequacy ratio, which is 12%. And for banks that want to expand, we tend to require a 12% capital adequacy ratio. And this is, again, very important. We've been doing that for years. As I mentioned, even as of today, household debt to GDP ratio at roughly about 21% is at 1/3 of EU average, less than 1/3 of EU average. More importantly, we do not allow Turkish citizens to borrow in foreign currency. This is important because we've seen the difficulties Central Europe experience on the back of this. Also, we've seen actually Turkish households difficulties they experience with FX debt or FX-linked debt back in 1990s. So households are no longer allowed to borrow in FX, and households have a massive long position in FX, meaning they have FX, foreign currency assets. They have foreign currency assets, but no foreign currency liabilities. That's what we mean a long position in FX. Again, if you look at corporate sector, including lira and FX debt, the leverage is there, but it's still manageable. And currency is flexible. This is real effective exchange rate all the way from late 80s. As you can see, there is a lot of volatility, even in real effective exchange rate. And in some way, you could even describe some mild heart attacks along the way. But the trend has been upward, meaning Turkey is on a convergence path, on a real convergence path. Turkey is growing faster. Turkey has better long-term prospects. So even if you had invested in Turkey, throughout these episodes of whatever you would describe, heart attacks, you would still have made money in real terms if you were to look at real effective exchange rate. Macroprudential framework, we've even strengthened that. Right now we have a Financial Stability Committee. This is important in terms of effective and timely response to stress. We also have Economic Coordination Board, which is led by Deputy Prime Minister Babacan. This is also very important because it does address not only coordination problem, but it also actually a good platform to push reforms through and also to avoid mistakes. We also have, of course, Treasury, Ministry of Finance, Capital Markets Board, Central Bank of Turkey, BRSA, the bank regulator and supervisor that does function well and try to make sure that the macroprudential mindset is lasted. So in short term, of course, the job is to reduce volatility, whether it's exchange rate volatility, whether it's interest rate volatility, whether it's inflation volatility. In the medium long term, the challenge is clearly to increase domestic savings and to make Turkey more competitive. Our macroprudential framework has been in place for years. European Union, United States began banking sector stress tests with the global financial crisis. We've actually been doing it regularly since 2004. The additional capital requirement has been in place since 2006. I remember when I was representing Turkey at G20 summit at ministerial level, these issues were only begun to be discussed. I mean, they began to discuss the policymakers from 2008 onwards. But we've had them in place from 2006 onwards. Again, limits on dividend distribution, in particular in the banking sector. to make sure that the banking sector capitalization remains strong was put in place in 2008, very quickly and timely. A ban on household foreign currency borrowing since 2009. Again, even for mortgages. In the UK, you could easily go and say, I would like to get a mortgage on my existing house that is worth 120% of my house. Banks were willing to extend you that type of loans. In Turkey, from the very beginning, we said, look, if you're going to lend people to buy a house, if you're going to extend a mortgage, it cannot be more than 75% value of the house. So you have to have, upfront 25% payment. This is very important. Of course, we do have many structural issues. Our structural reform agenda is very broad, and I don't have time, but I just want to mention them. We're combating shadow economy. We've made significant progress. Informal employment is down from 52% a decade ago to about 36%. The overall size of shadow economy is down from about 32% to about 26.5%. So there is a very strong progress. In fact, there is an international study that shows that Turkey is one of the countries that has been most successful in reducing the size of shadow economy. People on the street probably wouldn't agree, but that is the reality. Enhancing competition. We're trying to eliminate barriers to competition. We're trying to create a level playing field. Why? Because without competition, Turkey cannot be productive, cannot be innovative. And that is essential to a performance-based culture. That's essential to also international competitiveness. And that's exactly what we're doing. Deepening capital markets. Many of my colleagues mentioned about making Istanbul a regional financial center. That's what we're working. That's where Sukuk comes in. That's where alternative instruments comes in. But also, that's where savings come in. That's why we're telling any Turkish citizens that is 18 years and older, we say, if you save 100 lira, government will give you 25 lira on conditions that you don't touch it until you retire. I don't know of any more generous offer than this. And it's working, by the way. About 700,000 new participants have come on board in private pension scheme. We're talking about business angels, venture capital. All instruments are now in place. We're trying to get Borsa Istanbul, and Ibrahim is really doing a great job. But really, there is a long way to go in terms of deepening capital markets, in terms of reducing the domination banking sector. Local and renewable energy. Now that is also essential because last year we paid $60 billion to energy imports. And it's essential to reduce current account. It's essential that we focus more on renewable and local resources. That's also key to sustainable growth. Improving labor market flexibility. This is one area where we've had limited progress, but it's something that we really need to move forward. Education, absolutely critical. Whether we're talking about moving up the value chain, whether we're talking about competitiveness, whether we're even talking about avoiding crisis. Financial literacy, it comes with education. We've been spending on education. The share of education in the central government budget has doubled from about 9% to about 17–18%. This is a dramatic increase. We've hired 400,000 teachers. We have built 190,000 classrooms. We have doubled the number of universities. We're investing very heavily in technology. Now we are trying to improve quality of education. Infrastructure. We have prioritized infrastructure. And Turkey has made significant progress, whether you're talking about motorways, dual carriage highways, whether you talk about airports or ports or high-speed rails or traditional rail links. Across the board, there is huge progress, but the work is still ongoing. Moving up the value chain, this is the single biggest challenge for us, but with all these reforms in place, I'm absolutely convinced with more R&D, research and development spending, we'll get there. Finally, with the resolution of Kurdish issue, with the essentially this process, I'm convinced that Turkey will have a new engine of growth. In the past decade, Turkey narrowed the gap with European Union. So there was a real convergence on the back of Turkey catching up. With now southeast and eastern Turkey catching up with the rest of the country, it gives overall Turkish economy a new engine, a new source of life to maintain this momentum beyond a decade or two. So narrowing regional development gap is critical. We've improved quality of institutions, whether you're talking about corruption, whether you're talking about doing business, whether you're talking about competitiveness, across the board, there is progress. We have favorable demographics. Working age population is growing. In the last decade, real GDP growth per capita was roughly about 45%. On a PPP terms, Turkish GDP per capita has doubled. On a standard current dollar GDP, measures, Turkish per capita GDP has actually tripled. And the story is still unfolding. The story is still out there. I know this is not the conference, but it's important that if we're going to achieve this type of growth in per capita GDP, we do need alternative sources of finance, alternative sources of investment. We do need finance, obviously, sustainable finance for that type of sustainable development. And I think there is a lot out there. Bottom line is, there is huge scope for growth in this country and globally in Islamic finance and in participation banks, but broader terms, Islamic capital market instruments. And my government is committed to paving the way for development of both Turkey's own traditional capital markets, but equally important, having a significant component of this alternative Islamic finance in place. I'll be very happy to answer your questions. I hope I didn't go over my time, but I was told that I would have 10-15 minutes for the Q&A session, so I'm going to stay here. And if there is anybody out there who is interested in asking, I'll be happy to answer. Thank you very much.
Thank you, Mr. Minister. It's an excellent presentation, and he kindly accepted to answer a few of our questions, although we are a little beyond our time. So is there any question? So you would like to... yes, please. If you can introduce yourself and please be concise.
My name is Professor Richard Werner from the University of Southampton. I'm very glad to be here. Thank you for this excellent speech, Finance Minister. You've said some very important things. You mentioned that it is very important for the financial system to provide funding for the real economy, primarily for productive purposes, not for financial speculation. And of course, we will talk about this later, but I just wanted to ask ahead of this whether you have considered or would consider in the future particular measures to ensure that, for instance, a very direct measure that has been used quite successfully, also in order to prevent banking crises in East Asia, has been central bank guidance of bank credit with particular loan growth quotas, which is not only the quantity of total credit, but also restricting credit for speculative purposes. You did say that sometimes it's hard to distinguish, but there are ways of doing that. We could talk about that later, but you can classify bank credit by the use of the money, and credit for non-GDP transactions is financial credit, speculative credit is unsustainable. So one could actually do something very simple, have a simple rule that either this is banned entirely or it's restricted to certain small amounts which can be considered more sustainable. And I hope we can talk about the other alternatives later. Thank you.
Thank you. Our approach is not, I mean, we're relatively speaking, we're a relatively small open economy and fairly integrated into global system. Our approach is to provide incentives to banks to lend to SMEs, exporters, and the rest of the real economy. How do we do that? Let me just give you one measure that we have recently taken, just a simple measure. We told banks that if you lend to exporters, for example, capital requirement for that type of loans, is reduced. Or if you lend it to SMEs, because that way you provide an incentive rather than going out and saying, hey, you cannot use a portion of your assets or funds for that type, for that. Because there's always, ways of circumventing it. That way some of the funding goes abroad. When you're an open economy, they can do it through London. They can do it through Frankfurt or New York or Hong Kong. So it's very difficult to prevent them. But if you provide them with better prospects of returns by making it cheaper in terms of cost of funding through, as I said, either capital adequacy requirement or reserve requirement, for example, that way, or in terms of that way, maybe you could essentially persuade banks or financial institutions to lend more to the real economy. But unfortunately, there is no magical way. We can, that was a wishful thinking, meaning that was something that we thought it would be a nice thing that if it to happen, that would make it system more resilient. But the reality is, we do have a fairly complex global financial system. Turkey is part of it. And, what we need to do, we need to make sure that parts of system or alternative components of system that are less vulnerable to the type of shocks that we've experienced in 2008, 2009, also get a chance to grow. And that is the important part. So our approach is more to provide incentive for real economy lending, but also to allow parts of system that actually focus on that segment. So participation banks, for example, by definition, naturally they cannot lend for speculative purposes. They have to have a real asset. And that way, encouraging that component of system to grow is one way of making system more resilient. Thank you.
So we can have one last question. If there's a question from a lady, we can prefer that. Any questions? Okay. And any young?
No, we can be quick. We
Okay.
can answer.
Okay. Let's save the question from there. Okay. Mikrofon. Buraya.
Beni genç kabul ettiğiniz için teşekkür ederim. Servet Bayındır, İstanbul Üniversitesi. Sayın Bakanım, gerçekten bugün çok duygulandım. İslami finans alanında çalışan birisi olarak gerek Sayın Cumhurbaşkanımız gerek Sayın Bakanımız ve diğer konuşmalarda İslami finansa bu kadar önem verildiğinin vurgulanması çok önemli. Fakat sizin de az önce ifade ettiğiniz gibi özel olarak katılım bankaları ile ilgili katılım bankaları borç veremiyorlar. Aynı zamanda borç da alamıyorlar. Dolayısıyla katılım bankaları için bugün en önemli problemlerden birisi likidite yönetimi. Dünyada katılım bankalarının bu likidite yönetiminde yararlanabileceği emtia, future ve forward borsaları var. Gerçi İbrahim Bey'e bir atıfta bulundunuz. Belki doğrudan İbrahim Bey'in alanına giriyor ama bu emtia, yani reel türev ve sentetik ürünler değil, reel ürünlere dayalı emtia, future ve forward borsalarının Türkiye'de de gelişmesi, oluşması için hedefler var mıdır? Bu konuda çalışmalar var mıdır? Teşekkür ederim.
Yeah, you're right. I mean, liquidity is the biggest issue. Unless you have liquidity, the market is never deep enough, and it constrains growth of the market. I mean, it constrains, and one major constraint of participation banks and overall Islamic financial sort of instruments is lack of liquidity. I mean, I'm not an expert on Sharia-compliant products, but surely there must be ways of getting some of these instruments traded on stock exchange. Now, this is absolutely critical, because that way you can enhance liquidity. I mean, that is the single most important way. So my friend Ibrahim has a lot to obviously work on, and I'm sure we need to get together, we need to interpret. I mean, Islamic financial system needs to find ways of living along the sides of modern, financial system, or traditional financial system, and be able to grow without necessarily breaking some rules. And this is absolutely critical. To get sukuk, for example, like Islamic bonds, traded on the stock exchange would provide significant liquidity. One step we have taken is that Central Bank of Turkey accepts sukuk as collateral in interbank transactions. Now, this was an important step. And until a couple of years ago, as previous speakers mentioned, sukuk didn't exist in this country. In fact, speaking of sukuk was kind of like very dangerous. Let me give you an anecdote. When I first became the minister responsible for Treasury back in 2007, there was, I always thought that it's important to diversify our funding sources, our borrowing instruments. And so we said, let's work on this, and said, let's come up with a regulatory sort of framework that allows Treasury to tap this market. And one fear was that if we do that, prosecutor could use that as a pretext to close down the ruling party. So I said, okay, no, we don't want to be responsible for getting the ruling party closed. But anyway, those days are behind, but we also went through those days. So I'm sure we are at the early stages of these instruments, Islamic financial products and system. And I think that's why this conference is so relevant. That's why it's so important. And I'm very grateful to our president, but also director of SASRIC. It's very, very important that we actually have this debate, and this debate leads to more, obviously interpretation and development of products as we go along. Those who are unable to ask me a question while I'm on the podium, I'm happy to answer their questions as I walk out. Thank you very much. His Excellency IDB President El Medeni, distinguished guests, ladies and gentlemen, I'm delighted to be with you today, and I'd like to thank the organizers, the sponsors of this very important conference. A lot has been said, and I do have actually a presentation, because I tend to think that sometimes a picture is worth 1,000 words. And my presentation it starts with the recent global financial crisis, basically to tell you a little bit about what the deficiencies are and the implications for countries like Turkey, but globally, remedies that are in the work, in the process, and more importantly, a little bit of focus on whether or not we can find systems that are more resilient to this type of major, let's say, crisis. So let me begin with importance of macro-financial stability and in the light of recent experience. Well, typically, to have a financial crisis, you have to have policies that set the stage for the crisis. And the key here is loose monetary and fiscal policies that allow build-up of excesses, asset price bubbles or other excesses. So that really was the case. If you look at the last decade, prior to the crisis, you will see that both monetary policy and fiscal policies were actually fairly loose, in particular in developed world. Equally important, you also had everybody talking about global macro imbalances. We knew that there were imbalances, but obviously the difficult part is to pinpoint when those imbalances would lead to a major disruption. Financial deregulation and innovation has also contributed. I worked for many years in financial services industry. I worked in New York, I worked in London, Istanbul, for some of the relatively large global investment banks. And in particular, in the last decade, in the run-up to the global financial crisis, there was this idea of light touch regulation or self-regulation that essentially markets were reasonably efficient and they would have risk control systems and avoid basically shooting themselves in the foot. But the reality is we know that that wasn't the case, and probably that is not the last crisis, not the first and not the last. And I think it's important to have platforms like this debate ways of avoiding it and looking at other alternative sources, in particular sustainable finance for sustainable development. Of course, typically it's human nature that greed and reckless risk-taking or mispricing, let's say, that also exists. Whether or not there is a way of taming this is another important question. Just to show you a few pictures, when we talk about loose monetary policies, look at basically all the way from 1990s to the run-up to the crisis. What you will notice is that with the exception of a very brief period, US real interest rates were either negative or 0%. That was an important contributor. Loose fiscal policies, again, if you just look at the US, this is just a proxy for global policy backdrop. That's why I'm taking US here. Again, you will notice that even when US or the world were growing very fast, there were significant fiscal deficits. And that, again, probably did not help. Global macro imbalances. What you notice is that, in particular, starting from 2000 onwards, what you see is that emerging markets were putting their house in order. And on an aggregate basis, emerging markets were posting large current account surpluses, while US was posting very large current account deficit. Again, that is one source of the excesses that were being built up. So, to summarize, I mean, to look at the backdrop to the recent global financial crisis, you will notice a lot of factors that contributed. So you had asset price bubbles, you had lack of effective financial audits, asymmetric information problems, incorrect pricing of risk, loans used by people, I'm talking here subprime mortgages here, that actually didn't have the capacity to service, didn't have the capacity to pay back. You had transactions that were extremely difficult to understand, very complex. Only those who were marketing them or selling them had some idea of what those products were. So financial engineering was very advanced and still advanced. And clearly, many countries didn't import houses from US, but they did buy toxic assets built on US mortgages. And so you had many other factors. I'm sure you could add more factors here, but this is just a summary of some key factors. Einstein says, I'm not sure if everyone would agree with this, but whether that is relevant for financial markets, but he says 3 forces rule the world: stupidity, fear, and greed. When I was working in the financial service industry, this was described in a different way, that it was all about fear, greed, fear, and boredom. And certainly, probably, greed, uncontrolled greed, unsupervised greed is certainly one contributor. Now, what was the fallout from global financial crisis? Well, first of all, the world has experienced the worst economic crisis on the back of this financial crisis of the past 60 years. So for the first time since Second World War, we actually experienced a recession, even though it was a mild recession, but still a recession. More importantly, millions of people lost jobs. 32 million people lost their jobs. This is even more devastating. And unemployment rates are still, in many countries, higher than where they were pre-crisis. His Excellency President Abdullah Gül did mention that the countries, while trying to bail out private sector or financial institutions, they themselves they ended up with massive, unsustainable public debt and needed to be bailed out. And so clearly this chart tells you that whether you're looking at US, EU, or OECD nations, debt to GDP ratios rose dramatically to unsustainable levels. And that's why now we have this episode of fiscal consolidation. Of course, when you try to bail out private sector and then find yourself in the need of being bailed out, then the only avenue left, the only tool is left, is to print more money. And that's where monetary policy kicks in. And just to give you some color, Federal Reserve has printed, or its balance sheet has expanded by $2.7 trillion. Now, we've experienced a fair bit of volatility since late May, and that is largely associated with fears or expectations that Fed will change its course. Now that the US economy is recovering, that Fed will slow down or stop printing this much money. And that is causing some volatility in particular in emerging markets. If you look at European Central Bank, the picture is not that different. There was $1 trillion expansion. If you look at Bank of Japan, again, the expansion in the balance sheet of Bank of Japan is $1.2 trillion. If you look at Bank of England, again, about $460 billion of expansion. So all this tells you that clearly monetary policy has been employed to the fullest extent to basically prevent a global recession, which was caused by global financial crisis, from turning into a global depression. And in that sense, I think the world has been successful. Because if you go back to 1929, 1930s, the mistake there was to do the exactly opposite. So the fallout for the real economy in the Great Depression was much bigger. So I think we are grateful to G20 in a way that has helped coordinate these policies, has helped leading nations to cooperate and coordinate policies in a way to avoid another Great Depression. So we've avoided a Great Depression, but again, the fallout was still significant. Now, how can we avoid this? How can we achieve a lasting macro-financial stability? That's really the biggest question. There's quite a bit of effort that has been obviously put to that, to avoid that. If you look at globally, much is being done. I don't want to bog you down into details, but essentially there is a regulatory reform that is underway. So in particular, that is relevant for Turkey, in Euro area, there is significant progress on banking union. And Basel III is absolutely critical because Basel III is about having additional capital for the additional unit of risk that banks or financial institutions will take. I just came back with Prime Minister, I was with Prime Minister in St. Petersburg at G20 summit. These issues are still being discussed. In particular, the hottest issue or the more relevant issue that we need to make more progress is regulation of shadow banking, like hedge funds, etc. Supervision, again, is extremely important. We live in nation states, but financial markets are very much integrated. And so you cannot avoid spillovers. You cannot avoid major fallouts, even if you have tried and done your best to contain, to preserve your system, because there's so much. And that's why it's important that we now have a more effective financial stability, forum or other instruments. In particular, at European Union level, there's quite a bit of an effort. Coordination, as I said, at G20 level or Financial Stability Board level is very, very important. Financial literacy is extremely critical. It's an aspect that is not being focused much on, but it's very important. Not only, making citizens more financially literal, improving financial literacy of citizens, but actually it's also important that politicians' financial literacy is enhanced, is improved, as well as investors and others. Impact investment is an interesting area, which I think we can talk about it. Markets are not efficient. We've seen that markets have the capacity to destroy themselves as well as to destroy the real economy. And so the idea that markets are efficient, they can self-regulate, is not something to go by, is not something to be relied on. And so clearly markets need to be well regulated. And it is important to try to create an environment that allows or provides for channeling of resources or capital away from speculative areas to actually assets that are more helpful in terms of value creation. It's easier said than done, but maybe participation banks is one area to look at, because participation banks do not lend to they do not provide capital for speculative investments. Promoting investments that generate jobs and sustainable development is absolutely critical, and that means we need to go back to plain vanilla, simple financial intermediation banking. And supporting fairness and social equity, that's well beyond, obviously, just simple traditional financial system. Again, I'm not going to go into details, but there has been a fair bit of progress in both supervision and regulation of financial system, not only banking sector, but a broader financial system. Impact investment is something that is relatively new, but is expected to pick up very, very strongly. The idea here is to basically allocate more capital into investments that are more socially or environmentally, let's say, sensitive areas. According to International Institute for Sustainable Development, these type of investments are likely to grow to about $500 billion over the next 5 to 10 years, or roughly about 1% of global assets under management. I think this will be an important, relatively small at very early stages, but an important segment. Surely, following this financial crisis, there are a lot of people that are relatively more aware and more sensitive and probably more welcoming to these type of investments. Financial literacy, as I said, it's absolutely critical that we do something about this. And I think this is very important to avoid some of